Hey everybody, my name is Justin. Today I want to do a stock analysis on AT&T. This was subscriber picked, so I put a poll out this past week and AT&T won. The second company that came in was Foot Locker, so I'll probably be doing a video on Foot Locker very soon as well. So this is a full stock analysis on AT&T, ticker symbol T. And I gotta say, this is probably the most difficult stock analysis I've done in a very long time. AT&T has a lot of different moving parts right now. They actually spun off their DirecTV business earlier this year. They're in talks right now to spin off their Warner Media business with Discovery, which is supposed to happen mid-2022. And they had a bunch of write-offs here in the last year that really made their net income or their P&L kind of all over the place from a historical point of view. So we're going to go through all that in this video. So in this stock analysis, I'm going to talk about management. I'm going to do a business overview. I'm going to talk about these recent mergers or upcoming mergers. I'm going to talk about risk associated with this company. I'm going to be doing a 7-year financial analysis. And I'm also going to be doing intrinsic value, calculating what the company I think is worth today and what I would expect from return on investment from this company at today's dollars and potential future dollars as well. So like I said, this company is spinning off their Warner Media business with Discovery. I did a full video on Discovery already, so I'll put a link to that video down in the description below if you want to go check that out too. All right, so let's first take a look at the stock price over the last 5 years for AT&T. And unfortunately, it has been on a downward trend. So back in, I guess, the end of 2016, the stock was around $36 a share. It got up to $43 a share at the beginning of 2017, and then it's just been on a downward trend. Now they had an uptick, looks like at the end of 2019 here, but today it's trading at $25 a share, which is the lowest it's been in the last 5 years. If you've been a shareholder of AT&T and if you would have bought it 5 years ago, you had a negative 31% return, unfortunately. So obviously well behind the market. And like I've said in other videos, it doesn't really matter what's happened historically with the stock and the stock price. We got to look at today and then future free cash flow, future earnings of the company, determine what the stock price should be today and figure out if it's a good value or not. One of my favorite investors of all time is Peter Lynch, who wrote a book called One Up on Wall Street. He talks about in there when he managed a fund for Magellan that he made a lot of money on companies that did spin-offs of certain segments within the company, or a company maybe that merged with that spin-off, like Discovery, for example. So we're gonna find in this video if AT&T is good value or not. So now let's talk about the business itself and kind of what's going on, how the makeup of the business is. So first of all, AT&T is the third largest wireless carrier. They connect 66 million postpaid and 17 million prepaid phone customers. The firm recently sold a 30% stake in traditional television business, which is DirecTV, which serves 15 million customers and generates 17% of sales. AT&T plans to spin off Warner Media, which I just talked about, and merge it with Discovery to create a new standalone media firm. The remainder of AT&T will refocus on the telecom business, investing aggressively to extend its fiber and 5G networks to more locations, which they believe will build on the firm's core strengths. As a potential shareholder, I want to know how the revenue is divided up between the different business segments of AT&T. So that's what we're going to do right now. So the wireless business contributes about 40% of their revenue. Warner Media contributes about 20% of their revenue. Their traditional television service, which they sold earlier this year, was about 20% of their revenue. Their fixed line telecom services business is about 20% of their revenue. You can see it broken down more over here. This was pulled straight from their 10K for 2020. All right, so now let's talk about Warner Media and the Discovery merger, because I think this is really, really important for AT&T and their shareholders right now. So essentially what's going to happen is that the company's going to take the Warner Media business within AT&T, spin it off, and then merge it with Discovery. This new company is going to be made up of two different type of shareholders. So 71% from AT&T and 29% from Discovery. Now, $43 billion of debt is going to move from AT&T to this new company. 100% of Discovery's debt is still going to remain with them. So AT&T essentially is going to dump $43 billion worth of debt on their books. And that is good because they have roughly about $200 billion of debt on their books right now. In addition to this, the thought is that it's going to unlock the value of Warner Media and create this super giant in Discovery to go head to head with Netflix and Disney. All right, so let's talk a little bit more about the Warner Media and Discovery merger. This merger is going to allow AT&T to focus on their main business. So they're going to be able to focus on their 5G wireless network, their AT&T fiber network. AT&T believes this will position them well as far as revenue growth, margin expansion, and earnings growth into the future. And the articles I read, also listening to the last earnings call, reading through the earnings presentation, what I gather from this is that management said, hey, the company over time has made all these different acquisitions and DirecTV and other sorts, that they've got to a point where they've gotten away from their main business, that they really want to take a step back and focus on what they did best and focus on how the company was founded originally. And now let's talk a little bit more about this merger. So they think they can invest more in growth. That's AT&T, that is. They can focus on the 5G, success-based fiber expansion, investing for growth based on high return, flexibility for optimal value creation. They're going to target a dividend payout ratio of 40 to 43% based on anticipated free cash flow of $20 billion. So this is a really important item here because we're going to talk about this free cash flow and we're also going to talk about the dividend a little later in this video. We already talked about $43 billion of net debt that's going to be moving from AT&T to this new company merged with Discovery. This will also allow them to focus on more repurchase of shares, which they haven't done in the last several years. And some final points about AT&T. They are headquartered in Dallas, Texas. They have a $182 billion market cap, so massive, massive company. They have 230,000 employees. They did about $176 billion revenue this trailing 12 months. Currently, their PE is 193, which is really high. I would say a good PE for them is probably between 12 and 15. They've had some issue with income, which we'll talk about in this video. So the PE right now is very high. Last year was actually negative, but we'll discuss more about that in this video. So next up, let's talk about Moat. Do they have a competitive advantage in their market at all? And this is a bit stretching it, I gotta say, but they have somewhat of a networking and switching moat. And the reason why I say that is, there are certain areas of the country that customers can only get AT&T, but that's going to be a very small amount of customers in my personal opinion. And they do have somewhat of a networking moat right now with a combination of, or at least they did have a combination of DirecTV and HBO. So currently right now as AT&T customer myself, we actually have HBO Max, which is a nice thing. So that could create some value for a customer saying, hey, I'm willing to stick with AT&T if I can get HBO Max with that. Another thing is a switching mode. It's just a pain sometimes if you want to switch over to say Verizon or T-Mobile, that people may stick with AT&T because of that. But overall, I gotta say, AT&T has a fairly weak moat. And I gotta say, probably their biggest moat that they have is their Warner Media segment. And they're spinning that off and merging with Discovery. So I think the most valuable part of their business is not actually going to be part of their business in the future. All right, so now let's talk about management and let's talk about John Stankey. He's the current CEO of AT&T. He became the CEO in July of 2020. He was the president and the chief operating officer before that. Now, he's been with the company for a long time, since 1985. So you're talking about 35 plus years with the company. He has been all kinds of different positions with the company. So he's been there a long time. He knows the company really, really well. Now, as far as grading the CEO, for me personally, as a potential shareholder, I don't really like that they're spinning off Warner Media. That I think that has, like I said before, it's probably their biggest part of their moat that they have, and there's so much value in that segment of their business. Even looking at the P&L in their 10K and doing a deep dive into the management analysis within the 10K, Warner Media has some really good returns, really high ROIC compared to the rest of their business. So I would have liked the CEO to somehow use Warner Media in a better way with the company, somehow using it internally instead of spinning it off. That's just kind of my thoughts on that. All right, so now let's talk about financials, and let's do a 7-year review. We're first going to look at growth metrics, sales per share, earnings per share, free cash flow per share, book value per share. We're also going to look at management effectiveness ratios, ROE, ROIC, long-term debt payoff. And we're going to look at margins. When I was looking at these growth metrics and management effectiveness, they did not look good, which you're going to see. So I had to do a deep dive into the margins and do some more deep dives in the 10K to figure out what's kind of going on with this company, is figure out, is it being managed well or not? All right, so let's first talk about sales per share, and I want to see an upward trajectory, and we're not seeing that. So we're actually seeing a downward trajectory. We're seeing 25 roughly sales per share back in 2014, down to about 24 in the last trailing 12 months. Now, if you look at earnings per share, it's also downward trajectory from a 1 EPS down to just above even right now. Last year was a 0.73 negative, that is. And when I'm seeing this type of fluctuation in the earnings per share, I like to dig in and figure out what's going on with the company. So I first want to take a look at the P&L. I look at the cash flow, the balance sheet, see if I see anything that sticks out to me. I definitely do it in the income statement and the cash flow statement. So these two lines are highlighted here. These are impairment of goodwill. So you're talking about $10 billion of impairment of goodwill, and then another $8 billion of asset write down. And they also have another $1 billion of other unusual items that they wrote off in 2020, which is creating this huge net loss on their P&L for last year. So when I see this, I want to dig into the 10K. I want to know what exactly is going on and kind of give you guys a background of what I do. I'm an accountant by day, so this is stuff that I love doing. I love doing analysis, digging in. I know for some people this can be very confusing, and you may have never read a 10K before. I actually did a video teaching you how to read a 10K within 15 minutes, trying to find the most important pieces within the 10K, and I go over that. So I'll put a link to that video down in the description below if you want to go check that video out as well. All right, so let's go talk about those asset impairments that I found in the 10K. So as of the end of December 31, 2020, they had an asset impairment loss of 18 billion. So that was that 10 and 8 billion right that we saw before. So 10 billion was goodwill, and they had another 7 billion of long-lived assets that they wrote off. All right, so the company talks more about these write-offs down here, which I'll read, and then I'll just kind of put in layman's terms what they're talking about and what this means. So the company's ladder separation entertainment group reporting unit into the video and broadband reporting units required additional impairment evaluations prior to and after the separation, pursuant to which the company recorded a goodwill impairment charge of $8 billion, representing the entire amount of goodwill allocated for the video reporting unit. The company also recorded about $2 billion goodwill impairment charge for the Viro, I don't know if I'm saying that right, reporting unit, representing the entire amount of goodwill for that reporting unit. The company identified impairment indicators for its video asset group, resulting in the aforementioned about 7 to 8 billion of impairment charge. All right, so what does this mean? Why in the world are they writing this off? And let me explain this by showing the balance sheet to kind of give you an idea of what's kind of going on here. So if you go to the balance sheet and if you see goodwill under the asset section of the balance sheet, which I've highlighted here, you can see at the end of 2019, AT&T had $146 billion of goodwill. So what is goodwill? So generally what this means is that the company has purchased other companies at a higher dollar amount that the company is actually worth on paper. So what they've done is they've deemed a company that they like a lot, maybe DirecTV or that Vario company they were talking about, and they say, hey, on paper the company's worth $1 billion, but hey, we're willing to pay $3 billion for this company because maybe, we can get to a new customer base, puts it in our network, maybe we'll get more customers, which will lead to more revenue in the future. And so what happens if they're paying more than what the fair value of the company is it goes on the balance sheet as goodwill. And I extremely dislike goodwill on a balance sheet for many different reasons. One, it shows as an asset, almost looks like it's a good thing. But the issue to that is that every year, even sometimes quarterly, if it's a public company, they have to get with their auditors and they have to go through different testing. And they have to determine if the goodwill is correct or not. And in this particular case in 2020, they deemed that their goodwill was not correct, that there was about $10 billion worth more of goodwill on the books than there should be. So they do a write-off of that $10 billion, saying that company's not worth as much as what they originally thought it was going to be. And what happens is the items that are on the balance sheet flow to the P&L or the income statement. So this $10 billion write-off, which you can see went from 146 to 135 right here, that 10 billion hit the income statement as a loss. That's the write-off that we saw. And so the reason why this is so concerning is if this continues to happen in the future, that this can continue to be hitting the income statement and it'll reduce the earnings per share, which will bring less value, or at least what investors view the company as on a specific period of time. So that's why I don't like goodwill, because at any point this could be written off and it's going to hit the income statement and it's going to have a negative effect on the income statement. So these are amounts that the company has previously paid, but then they're expensing in a current period if they're impairing the loss. So hopefully that makes sense. Next up, let's talk about the free cash flow. So this is really good. So this is what I like to see. Now it's going up. So it's going from 1.9 up to about 3.5. So what that's telling me is even though earnings per share has been fluctuating so much, there's a lot of stuff that's happening after operating income that's creating all the kind of fluctuations on earnings. So we're seeing at least free cash flow going up. So at least that is a good sign for the company. Now, if we look at book value per share, it is going up. Not a lot, but it's going from $19 book value up to, it's roughly around 25 right now. What's really interesting about this is the company's trading around 25 right now. It is really hard to find a company that's trading around book value or even less than book value. AT&T right now is. So the idea around book value, that's equity of a company. So if the company were to liquidate today, sell all of its assets, pay all of its liabilities, this would be left over for the shareholders of the company. So theoretically, you actually get more value by buying into the company. Now you're buying at 25, but the company's worth 27, if that makes sense. All right, so now let's take a look at ROIC and ROE. So this is return on invested capital, return on equity. This kind of gives us an idea how well the company can take shareholder equity, debt financing, reinvest in the company. I like to see 10% or more per year. Gives me a good idea the company is managing their money very well. And they're really not. So they had 1 year of 10% here for ROIC, but they've been down in the dumps. I mean, 4 or 5% negative last year. So the numerator of this type of calculation is actually net income. So net income drives a lot of that. So that's why we're kind of seeing bad ones here. But in general, it's been down. And even ROE, which is return on equity, overall has not been over 10% on average per year. So definitely does not look good overall. Now let's take a look at long-term debt payoff. And basically what I'm looking at here is how long it's going to take for the company to pay off their long-term debt based on their free cash flow. I want to see less than 3 years. So the one good thing is it's been going down. So about 8 years worth of debt in 2014. Now they're over 6. This company has a ton of debt on their books. I mean, almost $200 billion worth of debt, which is very, very concerning for me anyway. Shares outstanding, it's been going up. So it's gone from about 5 billion in shares up to about 7 billion in shares. And they talked about with this Warner Media spinoff and merger that they'll be able to start buying shares in the future. But they've definitely issued about 2 billion more shares than they have in total. And my guess is a lot has to do with acquisitions that they've made. In order to generate some cash to buy some of those, they probably sold a bunch of shares is what I'm assuming on that. So gross profit margin. So because earnings per share was all over the place, I really want to take a look at to see what's kind of going on here. And this looks bad. It's going from 55% down to 52%. So it's a downward trajectory from gross profit margin. So gross profit margins look at gross profit, which is revenue minus cost of goods sold. So kind of up top, it looks like there might be some fluctuations that are going on. If I dig into net profit margins, this is very similar to what we saw for earnings per share. And this is how much basically the income or net loss on their books based on revenue, and it's been on a downward trend. So when I see gross profit margins, net profit margins going down, the next thing I want to take a look at is operating profit margins, because operating profit margins basically get rid of all the one-time adjustments or these other odd expenses or income that a company may occur. And we've seen that with acquisitions, all these write-offs that they're doing, these mergers, spin-offs. So I want to look and see what's going on here. And this actually looks good. So it's actually going up. It's going from 11% to 17%. So at least gives me a good idea that from an operating income perspective, that the company is going in the right direction if you're subtracting all those one-time expenses that are kind of going on their books. All right, so now let's take a look at my 7 key metrics and kind of seeing where the company is coming in there. And these are the metrics we saw before. So growth metrics, I want to see at least a 10% growth per year for each one of these. And so sales per share is 0%. Earnings per share is negative 35%. Free cash flow is 6%. Book value per share is 4%. So this is a no. This is a no. This is a no. All 4 no's, unfortunately. Now, management effectiveness down here, how well the company manages their money that they're given or they go out and borrow. And I want to see for ROE, ROIC, at least a 10% average. ROE is 9. ROIC is 4%. So that's a no on both of those. And then debt payoff, I want to see at least them paying off their debt within 3 years based on free cash flow. And it's 6 years. So that is no. So all 7 of these are no. So from a financial perspective, historically, and kind of where they're at right now, this company is not really well run, or at least has not been well run. All right. So now let's talk about dividends. And whenever you're talking about AT&T, dividends are really, really important. That's why a lot of people buy into the company. So let's kind of see what's going on there. So it has been going up from about $1.80 per share to $2 today. So it's kind of a nice upward trajectory there. Now it's not growing at a fast pace, which we'll look at here next. But currently right now it's at $2 a share. We're talking about annual dividend rate is 8%. The reason why it's so high is the stock has been dropping. I also like to look at the payout ratio. These are crazy numbers. 1,100%. Dividend cover ratio is negative 14%. So that gets me really concerned. Can this company pay the dividend or not? So we're going to take a look at that here in a second. Their 10-year growth for dividends is 2%. So not great growth. It is growing, but not that well. All right, so let's see how much they've paid in dividends over the last trailing 12 months. So they paid out $15 billion. If you want to find out where this is in the cash flow statement under financing cash flow, if you ever wonder where that's at. So $15 billion is what they paid the trailing 12 months. Their free cash flow better be higher than this to make sure they can pay for it. And it is. So they've had about $25 billion in free cash flow the last trailing 12 months. So they have about a $10 billion cushion right there. Now, what I really want to say about this, though, is the dividends are going to drop. There's no way with them spinning off Warner Media next year, which is supposed to go through sometime mid 2022, that they're going to continue paying out this sort of dividend. From what I have seen, I think this dividend could drop almost by half based on that amount. There's no way they're going to be able to keep this up. I really don't. With them being able to pay their dividend, be able to try to pay down pay for their debt on interest, be able to buy back shares, there's no way they're going to be able to keep this up. So if you're a shareholder, just got to put in the back of your mind that more than likely that we're going to see them actually decreasing their dividend at some point in the future. All right, so now let's talk about valuation. I do look at a couple different trends. I look at PE, what has been historical. I look at acquirers multiple as well. And then I do 3 different intrinsic value methods right here. So I look at earnings per share, project that out, what I think earnings per share will be 10 years from now, and then kind of discounting it back today to see what it should be worth. Look at a 10 cap valuation, which is basically owner's earnings of the company last year, and then discounted free cash flow model. So let's go take a look at PE first and kind of see where it's been. So it's been anywhere from, I would say, a high of almost 40 here back in 2015, hovering around 20 to 15 the last few years, and then took a huge dive because of that net loss they had in 2020. And today it's actually way up here. It's like 190. But I would say, a good PE for AT&T would probably be around 12 to 15. On average. Now, next up is acquirers multiple. I really like this one because it takes enterprise value and compares it to operating income. And just in general, if it's under a 5, that tells you it's a really, really good value. But in general, I like to look at where it's been historical. And it's pretty flat. I mean, right now it's around 12 or 13. It's been all the way up to 22, let's say. So from an acquirer's multiple, it does not look like it's good value. From a PE valuation, does not look like good value. So let's do a little deeper dive. So we're going to go look at those 3 valuation models that we talked about before, and then we're going to come back to my presentation, and then I'll talk about what I think return on investment will be for AT&T going forward. All right, so first up is my earnings per share calculation. And what I'm trying to do here is figuring out what the earnings per share is, and then slapping a growth rate to that for the next 10 years, and then figure out what the future earnings per share is, and then back in today's stock price based on my rate of return that I want. Now, earnings per share, if we look at the trailing 12 months, is almost nothing for AT&T because of that net loss they had in 2020. So in this particular case, what I want to try to do is really look at what analysts think the company is going to do going into the next year or two. And when I look into that, I think they should do around a 2.4 earnings per share. Seems to be pretty average. I think that's pretty consistent. As far as growth rate goes, I typically look at historical numbers and then look at what analysts think and kind of go from there. Unfortunately, historical numbers don't look good for AT&T since they've had a decrease of over 30% of earnings per share over the last 7 years. So I'm going off analysts. Analysts think right now around 5 to 6% growth rate per year. And according to management too, they do think they'll be in the lower single digits as far as growth. So I am going to use a 6% in this particular case. So based on that, I think it'll be around $4.30 earnings per share 10 years out from now, which would get to a future stock price of around $51. And then for a 15% rate of return, I would calculate the stock price right now to be at around $13 a share. So significantly below what it's trading at. In fact, it's 50% less than what it's trading at right now for margin of safety, which does not look very good. Now, if you're extremely optimistic about AT&T, you say, oh, I think they're going to grow, 10% over the next 10 years, which would be very, very optimistic. You could say then their stock price should be worth $30 today. If you say, okay, it should be around 6%, but earnings per share, I think should be more in line with $4. That would be a better estimate. What it should be, then it would be trading around $21. So you can see a lot of these inputs have a significant impact on what the stock price should be in the future. So what I'm trying to get to here is that there's a lot of different factors that go into valuation, and it's really important to have a margin of safety when you're buying into a company in case any of your inputs are wrong. Just simply don't get the growth rate or earnings per share. Next up, let's go take a look at 10 cap valuation. Essentially what I'm doing right now is looking at the trailing 12 months free cash flow, and then adding in the tax provision to get to owner's earnings, and then trying to figure out what I think the company's worth on a per share basis. And I think $30 is what the company should be worth based on this. Now, I want to say that these are estimates. I want to point this out. And the reason why I'm using estimates and not the trailing 12 months specifically is I'm trying to adjust for DirecTV spinoff earlier this year, and then also the Warner merger that's coming up, because it's going to reduce their free cash flow. When I go calculate what I think the free cash flow is going to be after the Warner Media merger, I think it's going to be around $18 to $18.5 billion per year for free cash flow. Management thinks it's going to be 20. So I'm going to go off what management is saying right now. I'm going to estimate 20 billion. I think that might be a little high, but I'm going to go off what they're saying. to figure out what that is. And so again, there is a little bit of margin of safety, 17%. So at least that looks good. Now let's go take a look at my discounted free cash flow model. So here I'm saying 6% growth out the next 10 years. Be consistent. I'm saying future multiples around 15% rate of return. I'm also saying about 20 billion as far as free cash flow, which is what management's estimating right now. And then I'm also subtracting out the net debt. So net debt right now for the company is around $180 billion. I'm subtracting out that 43 billion that we know that Warner Media is going to take with it when it goes to Discovery. So based on those inputs, I get an intrinsic share price about $17 a share for AT&T, which is well below what it's trading at right now. So now let's go jump back to my presentation and let me give you a return on investment, what I think this company could return going out into the future based on today's stock price. All right, so before I bring up my table that shows the ROI based on stock price, I do want to mention that this is just my personal calculation. This does not guarantee any future performance. You should be doing your own valuation, doing your own research. This is just how I'm looking at AT&T specifically. So just keep that in mind, all right? And I'm not a financial advisor, and this is not financial advice. This is just how I'm looking at it. All right. So based on my valuations I just did, this is what I think the company is worth. So right now the stock price is around $25 a share. So kind of right in this area. So based on that, I think the stock price will appreciate about 6 to 7% per year based on today's stock price. Now, if the stock were to drop down to $13 a share, that would be about a 15% rate of return per year. I get a lot of questions. Does this mean over 5 years or 10 years? This is a per year return on investment. Now, if the stock dropped down to $6 a share, I would estimate around 25%. And keep in mind, if you get a 26% rate of return per year, you'd be doubling your money every 3 years. But definitely think right now that the company is still overvalued, even based on the merger and spinoffs they're going to be doing. All the debt, I think the debt is a major problem, certainly of concern to me, and all the goodwill that they have on their balance sheet as well too. But this is what I think return on investment is for the company. Now let's talk about risk associated with this company. So poor financials. They have a lot of debt on their books. In fact, I was going to make a slide that showed all the debt that they have and all the maturity dates that they have. The amount of debt and the different loans they have out there it's crazy. I've never seen so many different loans that are out there for a company. It was so long I couldn't even fit it into 3 different slides. So I just didn't even show that. So they have tons of debt. Maturity is going all the way out to like 2090. This is pretty crazy. Poor growth metrics that we saw, very low ROIC, which is concerning. Massive amount of goodwill. I also think they've had some poor acquisitions. DirecTV specifically, I mean, their customer base was dropping. And even the companies they own currently that are part of that goodwill, if they deem that those are not worth they think they're worth, they're going to continue writing off some of those, and that will decrease earnings, which is very concerning. They have a high amount of CapEx for the company. Obviously with their 5G networks and all that kind of stuff, this is just company in general. Even look at Verizon and those type of companies. The industry just has a lot of CapEx. The Time Warner ROI and profitable segment. So Time Warner, when I was looking into the Warner Media business itself, it actually seems like it might be their most profitable or close to most profitable business they have. And I think is actually the biggest part of their moat that they own. I mean, Warner Media is huge. Once Warner Media and Discovery merge together, they'll be a juggernaut. The amount of channels and watch time that Warner Media owns is absolutely incredible. Definitely go check out my video again down in the description below when I talk about Discovery. When those two companies merge, they have more content for hours watched than anyone out there. So it is a bit of a concern spinning off Time Warner. What's that going to do to their bottom line? I do believe that a dividend decrease is going to come because their free cash flow is going to drop. So they're not going to be able to pay the amount of money in dividends going out to the future like they have. And then competition. So Verizon, AT&T, and T-Mobile own 90% of the market. Pretty incredible. Verizon is actually the largest as far as communication, wireless networks go. AT&T is second. I believe T-Mobile is third, but certainly a lot of competition. And for me personally, I don't think there's a lot of difference between companies to companies. I know some people do believe that, but I personally have owned like Sprint. I'm on the AT&T now. And depending where you live in the country, obviously that can make a difference. But in general, I would say that it's not difficult to make a switch from one company to another. All right, so now let's do a quick summary of this business. And here's the good. So book value per share. So right now the company is trading at below book value, which is pretty impressive. Hard to find that in this market. They are a strong dividend payer, even though the dividend is going to drop in the future. Historically, they have been paying out a lot of their free cash flow and dividends, which people love. Shedding segments and focusing on wireless and 5G. So they're trying to get back to the roots, what AT&T is all about. And management truly believes that they can really leverage revenue and earnings going out to the future based on getting rid of like Warner Media and DirecTV. Now the bad, poor balance sheet, high debt, a lot of goodwill, which is very concerning. Low growth expectations. Even the company's come out and said, low single digits is their expectation for growth. Just kind of put in perspective, this last quarter, they grew about 5%, their wireless business or their mobile business, communication business in general. So I would think it's going to be around that 5 to 6% going into the future. A very weak moat in my personal opinion. All right, so now let's go on and talk about stock grade for this company. Generally, I'll give a thumbs down for a company that will have an ROI of less than 8%, so that's worse than the market. Thumb sideways for ROI of 9 to 14%, thumbs up 15 to 19, and then double thumbs up if it's 20% or more. So AT&T is a thumbs down for me because I don't think it's going to keep up with the market. I think it's around 6.5%, 7% as far as return on investment going out the next 10 years. Now that does not factor in dividends, does not factor in share buybacks. So keep that in the back of your mind. But in general, I don't think this is a good investment, at least from how I'm viewing it in general. All right, so thank you so much for watching this video. I've been working really, really hard on this video. I've probably spent 20 plus hours on it doing research. And these are the type of videos I love doing. I will be continue doing going in the future. I love doing in-depth stock analysis. These videos that I do tend to be very long, but I don't feel like I can get all the information out in 20 minutes or less. So it seems like a lot of people are enjoying this. If you are getting value out of it, please smash the thumbs up button. Really helps out the channel a lot. If you haven't, I consider you subscribe to my channel. I love doing different stock analysis, looking into companies and bringing you guys value from an accountant's perspective. Now, different future video topics I'm looking into. I'll definitely be doing a Foot Locker one soon. Also, I'm going to be doing a Micron here in the next week as well. I'll be doing one on Hingham Institute, which is a small bank. Hunting and Ingalls, which is one of my largest positions I own. Excellent dividend payer. Also Ford, doing one on Hewlett Packard. Throw it down in the comment section if there's a specific video you want me to do an analysis on. Thank you so much again for watching. I really, really appreciate it. I'll catch you guys on the other side. Take care and God bless.